Welcome back to the Value Hunt podcast. And today I'm very happy to announce that I'm here with Bogumil Baranowski. And I'm not that good with introductions, so I'll jump right into the first question and ask you, who is Bogumil?
I'm doing your work for you, but I like that. It's a great question, but the way I think about it, if I have just a moment with somebody that I'm meeting somewhere briefly, I try to give them as much information as I can in a short period of time. So what I usually say is I was born in Poland. I went to schools around Europe, and then I discovered investing and found an opportunity in New York City where I spent most of my adult life. So New York really shaped me, both in a personal way, I think, and on a professional level as well. So I got to work in the value investing part of the universe, and specifically with families, multi-generational wealth that's invested with an open-ended, infinite investment horizon, very long term. So on one hand, I grew to appreciate the value discipline, Warren Buffett, that you have on the wall. And on the other hand, I grew to to see it as something in a bigger context. What is it that we do, and why do we do it? So we'll talk more about it. But what I really enjoy about what I do is that on one hand, I do know the investments that are in the portfolios, the actual businesses. And on the other hand, I know the people who are behind the portfolios that I get to invest, that I'm responsible for. So that's me in a nutshell, but we can dive into any of the pieces.
Yeah, I would actually love to dive in more because I always love this question. It's so simple but so deep. Sometimes guests actually stop and really start thinking, okay, who am I? How do I present myself? Because we kind of define ourselves either by what we do or something we believe in, so like value investors or whatever. So it's a really interesting question, and I would love to go back to your roots. I think
Mhm.
it's really essential if we really want to understand someone to understand what was the environment where they grown up and so on. So maybe you could go back to Poland and tell us how it was for you back then.
So it's a question that I ask on Talking Billions. Tell me about your childhood, and I like that you're borrowing that question. But I
Oh,
think,
awesome.
yeah, I don't take credit for that question. I just think it's so interesting to try to understand the beginning of the journey. And when you ask somebody who they are, I see it both as a journey. How did it get started? Where have you been? Where are you going? And then the question who you are, it's things that you do, things that you're passionate about. I think they can define and start a great conversation. But you start you're curious about the beginnings, and I ask my guests about it because I think any pursuit, any career you have to have some sort of a bigger why. Why is it that you committed all your life to a certain pursuit? And you might be an engineer, you can be an investor, you can be a doctor, you might be doing anything. But the bigger why, and I think it comes with time. It came to me with time that I started to look back to those early days, like the early memories, to see why I look at risk and reward in the investment world in a certain way. And I realized that those early days growing up in Poland was a very different country than it is today. It was the 80s, it was the last decade of the centrally planned economy, and economically speaking, it was not a success. There were shortages, despite of the fact that it's a pretty rich country with all kinds of resources, but the country was very poorly managed. And then when I was 10, Poland went through this massive transformation. The economy opened up, the free market opened up, and people could start businesses, import goods, export goods, and the country was booming. But it was such a big shock to the system that it led to huge unemployment. It led to a very high inflation, hyperinflation for a period of time. So I got to see the stock market reopen after 4 or 5 decades, and a lot of the things that were happening were kind of a lesson in economics and history and finance and markets condensed into 1 decade. Because the stories that I remember from the early stock market in the 90s in Poland, that they rhyme with the railroad stocks in the US in the early 1800s with very few stocks trading and all kinds of things happening. Hyperinflation or inflation, it's something that a lot of people haven't experienced until maybe recently, at least in the developed world. You have.
No, I haven't.
You haven't. There you go. But it's something that's very hard to imagine and explain. And the the way you even plan your home budget and you see that the prices are going up so quickly, the incentives are all over the place. So you want to spend the money quickly because the money is losing value. It's something that people wouldn't even consider and think about. And it had a huge impact on businesses and people and everybody at the time. So it left a lasting mark on my awareness that this is one of the scenarios. So if anything, I think those early days expanded my imagination. And I think later on when I moved to New York and I worked with a lot of American friends that went to schools in the US, grew up in the US, the things that they knew from books were things that I actually experienced. And I realized to actually experience and see things, it's very different than to read about it from the books. And then I met people from South America and Asia that went through all kinds of crises. And then I noticed that those stories rhyme and all those experiences early on shape us in a certain way. And I think that's why I have a very healthy, at least from my perspective, risk awareness. Like I want to understand the risks going into investing. And I think a lot of people go into investing to make money because that's the most alluring part. But for a moment, if you pause and you think about what can go wrong, and it's not that you have to obsess about it, just be aware. And it's the same way you're leaving the house and it looks like it might rain. And you can say, I don't care, I'll just go out. Or you can grab an umbrella or a raincoat, right? So sometimes it's just this awareness. Be an optimist, but be aware of what can go wrong. So I think those early days really shaped me in terms of the spectrum of different scenarios that can happen. And the last piece to it that drew me really to this family wealth aspect of investing, Poland went through so much change in the last 100, years. Two world wars, communism, and this was not really the place to preserve wealth. When you think about investing in the long, long term, you think not just about creating wealth, but keeping it. And you need a certain setting. And in my book, Money, Life, Family, I write about the location. So the location where the wealth stays has to have some characteristics, and the respect for property rights is one of them, but certain continuity. If your wealth will be confiscated, lost, burned, and so on in the process, you don't really have the runway, the open-ended opportunity to preserve wealth. So the United States and parts of the world have had 200 years to not only grow wealth but also to preserve it, maintain it. Don't So you don't have to start from scratch all over again. So that part of the setting or the upbringing really shaped me and drew me to that kind of open-ended long-term investment opportunity, not just picking stocks that go up, but seeing them in a larger context of wealth that could be compounded over many lifetimes. What does it mean? What kind of a setting is required?
Yeah, that's really cool, and I've been playing around with this idea of being a curator of great companies and so on. And like part of being a curator is that you are kind of building something that may last for longer than your lifetime. And it's quite an interesting exercise to actually be looking for investments that may outlive you and outlive families. So that's pretty interesting. But before getting into what you do, like in the present moment with your firm and so on. I'm really curious to know, like, I understood why you have this risk mindset and so on, but what ignited your passion for investing? Because once you have this background of like not being in a communist country and yeah, back in the day I guess there wasn't any internet, so you couldn't just go on YouTube and search for Warren Buffett or something. So
How did it
what
happen? How did he discover Warren Buffett without YouTube?
exactly, how did you do that?
Well, it was very old school, which means it was in a bookstore. I gave a TED talk that your listeners can look up. where I tell the story. And I was an exchange student in Brussels. So one third of the way between Poland and Portugal, where I find you today.
Yeah.
And there was an English language bookstore, a very small one, in a walk up in a small little building, 2 floors. And it was back in the day when people would grab a book and sit down on the floor and read a few pages and decide if they're going to take it or not, take the book home or not. So it had its own unique atmosphere, kind of a magical world where you can go and sit with books. It, I love books, so I'm a big fan of Kindle, but that experience of actually holding a book, I like that. And I recently went to a bookstore in London. I really enjoyed that. But I picked up a book, One Up on Wall Street, and at the time I was by Peter Lynch, and I was studying economics, business in Poland and in Brussels, and about to go to Paris to do my grad school. And I was learning a lot about a lot, and I think the key element here was my curiosity. I just wanted to make sense of the world. And maybe those first 2 decades of my life inspired me to understand, how does this work? And how come some places are successful and prosperous over the long run and some are not? And I thought that economics and business will give me the answers, both from the macro big picture and then the micro actual individual businesses that you hinted on. Why do they do better? Why some of them are special? What makes them special? But somehow I wasn't connecting the dots just going to school, although I was learning a lot at the same time. But One Up on Wall Street was a book that explained something very simple and powerful that now I see as obvious, but it wasn't obvious to me back then. And it was the idea that stocks are small pieces of businesses. And you could look at stocks as tickers and prices and charts and everything else. But when you pause and you think about it, when you buy a share of a business, of a company listed on the stock exchange, you become an owner of a tiny, tiny piece of a business. But that's no different than somebody that owns half of it or 2/3 of it, the original founder or the insiders. It doesn't really matter, or a big pension fund or a mutual fund. You, with a few dollars, you become an equal partner in a business. And that allows you to benefit from the success of this business. If this business is providing products, services, goods, and making a profit and expanding and going into new markets and making even more money and maybe paying a dividend, no matter how small of an owner you are, you're benefiting from this rising tide, and you're kind of piggybacking on somebody else's effort just because you provide the capital to this business. And this book really completely changed my mind about what the stock market is. Now you have to know the timing of it. It was the year 2000 or so, 2001, and it was soon after the internet bubble burst. So a lot of people had very fresh memories of losing money in the stock market. But as a refresher, it was a period of time when internet was something new. You were just making jokes about YouTube, but it was the early internet, dial up, very slow, but people got excited about it, that it will disrupt many businesses. And it happened, just took a lot longer, and it happened in a different way than people expected at the beginning. So anything with a .com in the name was trading at very, very high valuations. And the valuations are a funny concept, because if you have no revenues, how do you even value? So people would value as price per eyeball in terms of how many viewers to the website and so on. So it was a dreamland, and a lot of companies ran up in price very quickly. And there was this false sense that investing or speculating is easy. And then it came crashing. I mean, one good example is a company that's still around today, Amazon, and the stock went from $106, 106 to 6. And Jeff Bezos, you can look it up, wrote a letter to shareholders, and the first word of that letter is "ouch." So the stock lost $100, right? And I don't know what percent collapse it is, 95, 97, 98%, a massive, massive collapse. But he
Yeah.
said in that letter that the business is doing well, the sales are going up, and customers like the experience. And I think it was a terrific lesson in price and value, which is something I'm sure you're curious about, that some things have value and many things have a price, but to actually see the distinction between the two. Amazon continued as a business and succeeded and became a big part of our life today, but it wasn't an easy ride. Many companies did not make it through that period. All this to say, when I was picking that book, One Up on Wall Street, the sentiment, the atmosphere around investing was not very favorable. Maybe that's a contrarian bone in me that if a lot of people don't like it, maybe there's something about it. And I think that that really drew me in. My professors were not fans of the stock market. I actually had one professor specifically that was really not kind to Amazon at the time.
Well, maybe he had
um,
invested and he lost money or something.
yeah, can you imagine investing in Amazon at $6 back then? So yeah, those stories uh, shaped me. But the book One Up on Wall Street really ignited something really powerful in me, and I realized I'd like to be a shareholder of a collection of businesses that I value. And then the bigger context continued to develop. How is it that I can do it? What are the different kinds of investing, and how I can serve others through that, and offer my help as I'm learning. And I've been in the business 2 decades, and in many ways it feels like it flew by, but it was a very rich 2 decades of housing market crash, recovery at least mentally from the internet bubble, and then most recently we had the COVID pandemic and many other issues in between. So it hasn't been an easy ride, but the lesson from it all, that ownership of businesses is a one of many ways, but definitely an appealing way to grow your wealth over time. That's still true, and it will remain so as long as there are people willing to spend money and businesses trying to figure out how to serve them. Then you'll need shareholders to be a part of it as well. And the stock market is just this incredible place where you and I can go with no matter how much money we have and become a part of it. You don't have to start the next Microsoft. You can become a shareholder of whichever business that you find appealing.
Yeah, that's a great answer. And people a lot of times get caught up in the euphoria and so on and forget about those key fundamental principles that you're actually investing in a business. And yeah, basically, I was just talking at lunch with my father about Uber, and I was asking him like, I still can't figure out how does Uber manage to lose money. I think this year was the first one where their net income was positive, but other than that, they were losing like 9 billion, 3 billion, and so on. And I was asking myself like, how the hell do you make that happen? And like, it's such a big company, you can see their products everywhere, we use it every day, and they still manage to lose money. And that's pretty. I wonder how people invest in someone that's in something that's losing money, but that's a different story. Yeah, but I really liked your answer. And I think a good question to ask after this one is like, who are your mentors? And if you could maybe tell us stories about like some interactions you had with them. I'm a big fan of stories. I love to hear them. So maybe you could talk about that and really help us understand who inspired you and who still inspires you and helps you out understand and figure out the investing problem.
That's a terrific question. So I never met Peter Lynch. I met people that know Peter Lynch. I never
Okay.
met him. But in his book, he mentions Warren Buffett. And he mentions that Warren Buffett called him. And for him, it was such a big deal. And I didn't know who Warren Buffett was. And he, maybe today he's famous, but 23 years ago in Brussels, nobody was talking about Warren Buffett. So I looked him up and I started reading more about him, and I realized that there are books about him, and one of them that I liked was The Warren Buffett Way. And then I noticed that he mentioned Ben Graham, so I picked up Ben Graham's books. So piece by piece, I was looking for more information, more context. Peter Lynch kind of was the spark, the initial interest for me of discovering more about investing. But then I wanted to know what else I should learn. So Warren Buffett, in many ways, became a mentor that I never met. The closest I have gotten to Warren Buffett was when I went to the annual meeting in Omaha last year, and I wrote about it in my article, Return on Kindness. So I wasn't planning to go, and I had guests on my show, and they were asking me if I'm going to Omaha last year. And it was Lauren Templeton that finally asked me, why aren't you going? And I told her, you know what? I think I should go. And I went. And I would call it serendipity and kindness that led me to put my name down to ask a question at the annual
I
meeting.
saw that question.
You said,
Yeah.
and there are 50,000 people in the room, and so the odds are not in my favor. But we can talk more about the concept of odds and success, and I know you're curious about those concepts. So the odds were not in my favor, at least statistically speaking. So I put my name down. I was inspired by my friend Luis, who lives in Zurich, and they called me back. I ended up asking a question about 100-year vision for Omaha, for Berkshire in Omaha, and they gave me a beautiful answer and leaned on Ben Graham and his teachings and so on. The reason I was curious about the 100-year vision is that how I think about wealth. You're building it for yourself, for your future self as well. You 20 years from now, 40 years from now, but also potentially for people that will follow. If you're successful, the capital will grow. And even if it's not hundreds of billions, it might be meaningful that there will be wealth that you will pass on. So I was curious about a 100-year vision because that's how the families I work with think about wealth in terms of a long term approach. I think it relaxes you from trying to win any short term races as you go, right? You don't have to be the best in every quarter. Nobody can really accomplish that. But having a respectable rate of return over long periods of time. I think Howard Marks said that he wants to be average, but over a very long period of time. And I think there's some wisdom in it. So Warren Buffett and Charlie Munger had a huge influence on me from afar, and interacting with their books and writings and the letters, and then the annual meeting. I went to the annual meeting first time when I was just a young analyst working for an investment firm in New York, and it made a big impression on me. I highly recommend, by the way, going to Omaha at least once and seeing what it's all about. It's a very different shareholder meeting than a lot of other companies host. And in my article, I mentioned how it's the shareholder that's on the pedestal here. We talked about it, a small piece of a business, the fact that you are treated by Warren Buffett or whoever is in charge of the firm, any firm, the same way as the original founder, and you get to benefit from their success. So these were the two that had a big influence on me. And there were many people I met in between that had an influence on me. I met Guy Spear at some point, and then we interacted a lot more. He was on my podcast. I attended his Value X over the years. So he had a big influence in terms of both not just thinking about investing, but a bigger picture. His idea of compounding goodwill really spoke to me. How the little gestures, I take calls from people and I spend sometimes 5-10 minutes with somebody that is listening to my podcast or read my books. And I feel like that those 5 minutes that other people gave to me, I can give back. And they have a huge impact on their life as much as those 5 minutes that somebody gave me at different points in life that kind of course corrected me in different ways or gave me an inspiration, maybe encouragement. The other people that had a big influence on me were definitely related to my business. So I would mention James Hughes. You can look up his books. He writes about family wealth, but it's somebody that I look up to, and that's somebody that had a big influence on me in terms of thinking about long-term investment horizon with a family context. And he has worked with many families over the years around the world, and he's just a remarkable resource and inspiration to me. I have to mention Tony Deeden, that many people might have heard of. He's based in Switzerland, and listeners can look up the famous video interview with Grant Williams uh, with Tony, where he explains how he thinks about investing and in many ways extrapolates on the idea that I mentioned at the beginning, how stocks are small pieces of businesses. He calls them participations, that you basically buy a participation in the business, But when you are listening to me right now, you might have noticed that there's no trading going on, right? There's no buy to sell. It's more of what kind of
Yeah,
businesses would you like to buy to hold as an owner, right? So you go in not in the
exactly.
mindset of at what price am I going to get out of this investment. It's more of, am I holding the right investment for the long run? Does it serve my purpose? And Tony has a great way of explaining it in the context of also having a huge respect for what that capital means. It could be a lifetime of savings for a family or an individual, and how it's, I like to say that it's the capital the clients don't immediately need, but it's the capital they can't afford to lose. And I think it
Yeah,
sets a certain, very helpful for me, framework to see each investment in that context. And there are certain risks that are not worth accepting. I think that's the shortest way to describe it. But anyways, many people, including Francois Sicart, that hired me for my first opportunity in New York. He was working in New York and visiting some clients in Paris, and he invited me to have an internship with him in New York, and he opened my eyes to a certain kind of investing. Very patient, very disciplined. And I do remember our first conversation. Speaking of stories, and I don't know where it came from, but it's kind of like a little mental fossil in my head. Like I remember vividly the topics I brought up, and I sat down with him, and I had more questions for him that he had a chance to ask me, which was amusing, I'm sure, for him. But I wanted to know, what is it I can do not to lose money investing? So I was already very, very passionate about investing, and I read everything I found at that point, and I was very familiar with Buffett and Munger and many other people. But when I sat down with him and seeing him as a true practitioner, somebody that actually does it, and I asked him, how do you avoid losses? And I know it's not possible, but I wanted to know how I can minimize losses, because in the back of my mind, I thought, if I can figure out a way to minimize losses, the winners will take care of the rest. But as long
yeah,
as I don't have true, whatever the term you want to use, blow ups, I call them zeros, as long as you find a way to limit those, then the upside will take care of itself. And I think that's the biggest secret to investing. You want to stay in the game, and you want to be able to compound over the long run. And the only way to do it is to avoid massive losses on the way. But I'm sure we'll circle back to it.
yeah, sure. Anything times zero is still zero. So
There you
you
go.
don't want
It's
to. Yeah,
it's such a simple concept, but it's hard to grasp. I have this philosophy or a principle, you could say, that I don't want to put anything in the portfolio that could be a potential zero, that I can imagine being a potential zero, right? So to me, there are a couple of sources of it, and it can be what I call secular decline, high leverage, or questionable management. And when I say secular decline, I mean an industry that's basically shrinking. For some reason, it's going away, and the consumer is shifting away. Whether it's newspapers, TV faced it, different industries, Kodak with film cameras faced it. It's very hard to fight that kind of a trend. It, high leverage, a lot of debt will get businesses in trouble sometimes in a way that they just can't recover. So that's something I like to pay attention to. And when I say questionable management, I don't mean it's outright fraud. It might be somebody that's over promising, under delivering. But you have to remember, when you buy a business, you trust with your capital and your client's capital. You trust somebody. You entrust that capital to somebody when you buy their shares. So you have to have people that you think are the right partners with you in this venture. So that's something I like to pay attention to. And with zeros, it's interesting because people say, well, if you have a diversified portfolio and say 30, 50 stocks, just for the sake of the argument, and a couple of them are potential zeros, how bad can it be? Why is it an issue? I think, to me, the challenge is that if you start to allow those potential zeros into the portfolio, time may happen when too many of those are potential zeros, and a perfect storm, which happens now and then, can take out too many of them, and the damage can be too big to recover. I had
yeah.
Vishal. Go ahead.
Sorry, sorry.
Now, I was going to mention I recently had Vishal Khandelwal, who is an amazing person and a great writer, and we had a wonderful discussion about losses. Like some losses are very hard to recover from, and that's something important. We started with the risk awareness. That's something that I think is very, very important. Just to be aware of what kind of losses, what kind of risks are just too hard to recover from, and maybe you shouldn't include them in the range of scenarios that you allow to happen.
Yeah, I was about to say, I really agree with what you're saying. I think you really have to be picky about what you allow into your portfolio. And I was recently reading the letters to the partners of the Nomad Partnership.
Yes,
I'm
next leap.
sure you're familiar with it, but maybe the viewers aren't. So Nick Sleep is one of the greatest investors of all time, and he has a terrific track record. He was an early investor in Amazon and so on. But anyways, he talks about the ways that investors can like make mistakes and calculate the mistakes and so on. And he speaks about this concept of drifting. So it's not like you uh, like if you start allowing those potential zeros to come into your portfolio, all of a sudden maybe 5 years, 10 years pass, and you don't notice the small changes, and you really start allowing more and more of those businesses to come in. And when you really notice it, it's too late to make like adjust, readjust, and you already let the bad behavior affect you and create a habit. So, like Warren Buffett says, the chains of habit are too light to be felt until they are too heavy to be broken. And I think that's a good anecdote to encapsulate that insight. And it's really simple but not easy, because you obviously it takes a lot of discipline, and I was curious to know, like, this wasn't a question that I was thinking about asking you, but I'm really curious to know, how does like the um, position sizing look like for someone that's trying to build a portfolio that will last for, say, 100 years? Because that's really a long time. So that really strikes me as an interesting question. I would like to know that.
It's a very personal decision, and if you're managing other people's money, you have to take into account how they feel about it. But the formula that I've been using the most is a portfolio of about 30 to 50 stocks. So if you
Okay.
do the math, an average position could be 2 to 3%. I think something fascinating happens in a portfolio that I noticed, and let's say that there are at least three buckets, three categories. One is businesses that have created an opportunity that I see to impress me in 3 to 5 years. It might be some short lived issue. I like to call myself a value buyer and a growth holder. So I want to see an opportunity, a deal, a bargain. And sometimes the time frame is 3 to 5 years. That's one side of it. The other side of it, and I'll come back to the middle that I'm the most excited about. The other side of it is some sort of income. Given the nature of the clients I work with, it's nice to have some sort of a dividend income. And of course, you can create an income by selling shares, but having businesses that are at a stage of their life where they can pay a dividend, it's something that's helpful. So there's a component to it. But I think the most interesting thing happens in kind of the middle of the portfolio, which, historically looking back, I realized it's about 20 stocks or so. And I like to call them the 20 stocks for 20 years or so. And interesting things happen because these are the stocks that pull the most weight in the portfolio. They're the ones that really impressed me. They're the ones that had the longest runway. So they went far beyond the 3 5 year horizon. They had much more to offer than just a dividend. Maybe actually they had no dividend, more of an appreciation. But they deserve the 20-year wait. And this is the category where I think the magic happens, and only certain kinds of investors can wait that long. I had a client ask me about a stock for a grandchild. I wrote an article. People and your listeners can look it up on my Substack. A stock for a grandchild, because a grandchild is a perfect 20-year investment horizon client. Right, the grandchild will not need the money for 20 years. But that question got me thinking about a model, a framework that I'm using anyway when I think of that heart, the core of the portfolio. That even you, when you think about your future self, if you can wait 20 years, what kind of investments would you make? And the initial answer that people have is the most established brands, very mature businesses that will be around in 20 years. But that's not the question I'm asking. I'm asking, what kind of stocks deserve for you to wait 20 years? So the stocks that will go from $8 to $80, right? These are the stocks that will go up, 10, 20, 50, maybe 100 times. Chris Mayer has a wonderful book about
Yeah.
stocks that go 100 times up. And there was an earlier book by Phelps about 100, 100 to 1 kind of stocks. But it really expands. We talked about expanding your imagination. There are businesses and there are stocks that are worth waiting. We know that Berkshire Hathaway was such a business worth waiting, that long. But that's the place where the magic happens. And 20 stocks is also an interesting number because studies show that we diversify away the individual risk of an investment around 18 or 20 stocks. So it's also an interesting number. 20 years is also an interesting time frame because when you look at research, companies might be around for a lot longer, but their glory years, their peak years, the time when they belong to the top companies in their category or overall, it's usually around 18 to 20 years, which is fascinating when you think about it. So if you want to capture that highest value creation period of a business, it might not be 100 years for an individual stock. It might be 20 years, right? So it's interesting to think about it. But your question was position sizing, and I added a bit more to your question.
Oh, feel free to do that whenever you want because uh, I kind of set the stage and you run the show, you know. So that's the goal here. Um, like this is a more tangent and follow-up question. Like I run a slightly more concentrated portfolio just because of a few reasons, namely mainly like I feel comfortable with it. I think it makes sense, and also I don't have that much time to follow companies at the level I want to follow, so I can follow like 50 stocks, 50 businesses at the same time and really understand them at the level that I want to understand. So uh, I have a handful of companies in my portfolio. So how do you keep up with so many companies, or like how do you think like the diversification uh, offsets the let's say the more less deep analysis? I mean, I'm curious to know how deep you manage to go when you have like a 50 stock portfolio.
So I look at it as the research process, the way it's built. After being in the business for 20 years, there are very few names that I would like to own and I have never looked at. I don't think there are many. When I come across a business that I'm interested in, it ends up on my watch list. I'm curious to get to know it. And over time, I might have looked at most of the businesses, if not all the businesses that I could potentially own at some point. I have some sort of an opinion. I might not know all the details and all the product lines and all the number of locations, but I have a pretty good understanding. You kind of hinted that you have a good grasp on Uber, not not picking on
Yeah,
any individual
no,
stock
no,
here, but you have it, right? And you collect it over time because you look at another business and another business, another business. When companies go public, I look at them because to me it's a new kid on the block, right? A new potential investment. And it really takes an initial read through to understand this is something I'd like to own or it's something I don't think I'll ever own. And it's a certain filter that I think I developed over time. and maybe it narrowed over the last 2 decades, but I have a pretty good idea of what I would like to own and why. Now, one thing is to identify a business that I'd like to own. The other thing is to actually buy it, right? So the price matters. I told you how I like to call myself a value buyer. I want to find a bargain and a deal. So the business might qualify in terms of what it is, the quality of the business, the kind of margins that they have, and all the metrics, market size, position, some unique model about them. People call it a moat, something that they can defend. You can name it various ways, but basically a business that offers a growing cash flow or a promise of growing cash flows. Because what we really buy as a business is the cash flows. That's the reason to own any business. You want to see that the money will be coming back to the company, and then if you're the shareholder, it's really your capital at the end of the day. If the company cannot make money over many years, there's something they haven't figured out and maybe flawed unit economics. We've seen some businesses get listed on the stock exchange that are basically giving away $100 bills for $50, right? So that's not a sustainable model, and you can figure it out. And then you can go as deep as you want, and over time you get to know those businesses. It's almost helpful to go with a business to through a couple of corrections and crises to see how the business responds, how the management responds in different scenarios and backdrops. So the depth kind of happens over time. I like to think of investing as something that you do gradually, unless you have kind of a once in a decade buying opportunity like March 2020 when all the stocks were on sale. But other than that, you have the time to build up a position gradually and have time to gradually exit the position. And that gradual aspect to it allows you to minimize your mistakes. I like to say that I want to be the least wrong. And to be the least wrong, one of the ways to go about it is to go slow when it makes sense to go slow. But once you buy a business that you know, that you respect, and I don't want to name too many businesses, but I'm sure you can guess which ones are worth holding, then it's not that you have to check on its every move, because you know what to expect from it. Let's flip it on its head. If you have something in your portfolio that you have to check on every single morning because you don't know where it will open at what price, maybe you're holding the wrong thing. That's how I look at it, right? But if you know the business, if you know what they're about, if you know what the pricing looks like, if you know what the margins look like, yes, they'll have better or weaker quarters on the way. But it shouldn't be a business that will surprise you and shock you. And if it does, maybe it no longer belongs in the portfolio. So that's how I look at it. So it's an accumulated effort that happens over the long run. Here I would mention one thing that I found very, very helpful. A lot of people are very obsessed with a price target when they buy a stock. And I don't know where it comes from, but I noticed, and maybe I experienced it myself too. It gives you maybe some sense of comfort when you buy a stock at 20 and you say, well, it's a $40 stock. There's something peculiar that happens at $40 once you reach that target. It's so tempting to sell it because you said it's going to be at 40. And
Yeah.
if that business has really good returns on capital, it's reinvesting in the business, it's adding more locations, it's adding more products, it's entering more markets, it's expanding its offering, and it's getting bigger and better as it grows, which is the case for some businesses. Why sell it at 40? Why not wait for it to go to 80? Why maybe not sell it ever, right? Like, so I think
Yeah.
it's a fascinating shift. And it goes back to your position sizing, which is a very loaded question, because I think the second thing that happens is that people have position limits, or they have a size in mind where if the stock goes over 5% or 10% or whatever, they don't feel comfortable holding it. And I think that's a very tricky place to be in. And I relate to that too, and I understand where it's coming from. But you might be leaving money on the table. So the best thing or the least that you can do is to do it gradually if you're going to end up trimming a position because it became so big. But it's something really interesting because I'm sure you've heard of the coffee can portfolio. Have you heard of the coffee can portfolio?
Yeah, I was about to mention before when you talked about Chris Mayer and 100 to 1. He's basically a big inspiration to me, and I've watched pretty much everything he said, and like yeah, so I'm familiar with that. I'm trying to follow it and apply it myself. So
So Chris was twice on Talking Billions on my show, and he's
I
just
saw.
incredible, very very thoughtful guy. But the Coffee Can portfolio, it's based on Robert Kirby's article from way back. I don't know if it was the 70s or 80s, but basically,
Yeah,
very quickly for the benefit of your audience, this money manager noticed how a particular account that was, I think, the spouse of one of the clients was moved over after that spouse passed away to that money manager. And he noticed that that portfolio was very peculiar, very strange. And what was strange about it was that it had the same positions that that manager was buying in the other spouse's portfolio, but that other spouse would never sell the shares. So he or she, I don't remember, I think it was the husband, that would buy the same amount of dollar amount of shares of the companies that this money manager would buy for the wife, but never sell. So the outcome was that the portfolio had huge, huge positions in very few stocks, kind of like the 2020 idea I mentioned earlier,
yeah,
and a lot of very tiny positions that didn't go too far or on relative basis didn't perform as well. But it was the workhorses of the portfolio that made all the difference. And his biggest secret, I don't know if he was aware of it or not, but letting them run was the biggest success source for him in this particular situation. But I found it really inspiring, and I haven't seen too many people actually apply it in the real world, especially when you manage other people's money. It's very tricky because large position sizes cut both ways, right? You want the winners to be big, but even the winners have tough years. They have periods when the money, when well, the price goes nowhere, or the price comes down substantially. So if you have an oversized position in a company that has a 50% drawdown, it's a very hard experience for you and for the client. So I think there is some sort of a balance. That's why, to me, you can look for the algorithms, equations, and
value
systems and
criteria.
approaches. Yeah, but then it's the real life where you sit down with somebody and say, is this an investable portfolio, in the sense, will you be able to hold on to this portfolio and sleep well through the night? If the answer is yes, I think you're onto something. If the answer is no, I think you have to find some sort of a compromise, whether in terms of the stock selection or the position sizing, that will allow both of you to sleep well.
Yeah, that makes sense. Hopefully, I'll be one of the few that will actually run the experiment until the end and see, yeah, if I can apply that idea, um, yeah, in a disciplined way. But anyways, now moving on to a question. This is more like personal question. I'm really curious to know this, and I'm going to read it because it's a bit more technical and so on. So for the less, let's say, savvy viewers, maybe you can skip this part. But I'm really curious to know what's your opinion. Okay, so we had some technical issues, but we're back again. And I was asking a question, but it was so long that it would bore you too much. So I'll make it more concise. So basically, in portfolio management for investors with smaller net asset values,
Yeah.
experiencing significant capital inflows, what's the most effective way to manage those capital inflows, especially for private investors where like their salaries or freelancing or side hustles make up a big part of their current portfolio.
I think it's a great question. So the big picture framework that I think about when I think of clients and people with the ambition to grow wealth over the long run or take care of wealth, I talk about a lifetime of distributions and a lifetime of contributions, and I'll explain the difference. And I think it will shed some light on your question. The clients that I work with, they usually have substantial wealth, and either they inherited it or they had a liquidity event, they sold the business, they had a pay compensation, significant compensation from their employer, and they're facing what I would call, one way or the other, sudden wealth. substantial wealth. And they have to think of a lifetime of potential distributions. So the capital has to be invested, and over time it will be used and spent and so on. They will be living off of that capital as it grows. The majority of investors are living in a world of a lifetime of contributions. They put away a little bit of money over time, whether it's €100 or $100 or $10 or 1,000. It doesn't really matter. But they have the certain advantage here because they have time to learn and make mistakes and tweak. When you have sudden wealth come to you, substantial wealth, you kind of have to have either great advisors on your side or take time and effort to prepare for the big responsibility that you're facing. And hopefully, maybe you have both. You have some guidance and you're very engaged in the process as well. But if you have a lifetime of contributions, you can continue to tweak it. So you can start off with maybe some passive options, as in index funds that allow you to buy many different businesses at the same time, because that's what an index fund is. It allows you to hold many businesses at the same time. Maybe as you do that, you want to experiment with holding individual businesses that you respect. Maybe you research them. You want to be more engaged and involved. You can do that. So you have many different ways to tweak it. You can also tweak, how much you contribute. And you said people have salaries and hustles and so on. Maybe start with some sort of a minimum commitment that you have that you want to put towards your investments, and then grow it from there, or assume that any capital, whenever it comes to you, some percent of it goes towards investments. Have kind of a more, I want to say, automated plan, because if you commit to something, it's easier to deliver if you say that that's what I will do. And as long as you do it in a very disciplined way over a long period of time, the details kind of matter less. So I think some people are obsessed or focused too much on figuring out if this is the right market to go in. Is it low? Is it high? Should I wait until it bounces back? Should I wait until it drops? If you're doing it over a lifetime and you have a lifetime of contributions, it becomes really secondary, because your investments will be spread out over time. You don't have to second guess. Now, again,
Yeah.
if you have a sudden wealth coming to you and you decide to put it all in an index fund, and you happen to be at the peak of a historic bull market, for example, you lock in your cost at a very high price, and you have very little flexibility from that point, right? So that's something that probably a lot of people would consider to be not something they want to do. Now, lifetime of contributions, you put in the first $100 at a market peak, the second $100 in a month that resembles March of 2020. It averages itself out, right? And if you can see investing as a lifelong pursuit, the same way you want to pursue knowledge, right? You say, well, which book should I read? And I will never read another book again. That's not the right way to look at it, right? You will read this book this week, another book next month. It's a lifelong pursuit. Some of those books will be great. Some of those books, you'll probably stop reading 10 pages into them. They realize, well, maybe it's good for my friend, but it's not for me. It's the same with investing. If you can see it as something that you do regularly, then some really interesting things can happen. Compounding as a concept, I think a lot of people talk about it, but it's very hard to grasp how compounding works, which is basically interest on interest. And to me, the biggest visual that I have is when you look at Warren Buffett. That's on your wall behind you. Warren Buffett made the majority of the wealth that he has, and I don't even know how much he has today, 80 billion, 100 billion, I don't know, but up there. The majority of it he has made after his 55th or 60th birthday. I don't know if it's
Yeah.
97, 98%. I think Morgan Housel shares it somewhere in his writing, in his book. But that idea that somebody that started so young, I don't know if he started at 11 or 8 or 9, depending on how you counted the first stocks that he was buying. So, and he's 90 some years old now. Is he turning 90 this year? No, 90
I
something,
think it's
93.
90, yeah, 94 something, but I can
90,
look it up.
right? So we're talking about at least eight decades of investing.
Yeah.
So if somebody that has been investing for 8 decades and still made the majority due to compounding after his 60th birthday, that kind of shows you that image of compounding as a little stack that's going steeper and steeper and steeper and steeper and steeper. So if you give yourself a long, long runway, some really interesting things can happen. I want to emphasize one thing when people think about investing. You know, there's some pursuits in life. I think Tom Gaynor from Markel, in an interview with William Green, I believe, had this interesting story about seeing some pursuits as winner takes all situations. Like if you have Olympics, a race, you remember the first person, you maybe remember the second one, but you don't remember who was fifth in that race, who was running
Yep.
really really fast, but they were the fifth. You don't know who they were unless you really follow that particular sport. In investing, it doesn't work that way. So when you're sitting in Omaha at the shareholder meeting, and I highly recommend the Return on Kindness article that I wrote. I think it was a great way for me to remember the whole experience. I think your audience would enjoy it too.
Sure, I'll
And I
make
was,
sure to put it in the description.
thank you. I was looking around and I was thinking, yes, you have Buffett on the stage that year, and you had still Munger on the stage. And Munger had a fraction of the wealth that Buffett had, but he was still a billionaire, right? So in terms of a race, some races are won by a fraction of a second. Investing is not a race; it's an open-ended pursuit. And I think the sooner you get that, and you realize, well, I'll try to do what Buffett did, for example, and I will only get to tens of millions or even millions or maybe even the first 100,000. It doesn't matter, right? It's your own game and your own pursuit. I like the idea that that initial uh, capital that you save and invest. Morgan Housel has this saying that the first paycheck that you get is the most important, because you go from having an empty fridge to having something in your fridge, not being able to pay rent to being able to pay rent. And I hope a lot of people don't experience that, but let's say that's like the ultimate first paycheck that gets you over the top and you can actually pay your bills. And he says that no money in the future has the same kind of impact on you.
Yeah.
I'm paraphrasing, but that's what I heard reading his book. And I thought it's such a powerful idea, because if you go from a billion to 2 billion, and I haven't experienced it yet, I'll tell you when I know, but I imagine it's not as life changing as the initial money that you make. So if you have 6 months of savings, 6 months in terms of expenses of savings, or 12 months, or even 5 years, these are very powerful milestones. So the goal is not to obsess to become the next Warren Buffett and be the number one, number two richest person in the country. The goal is to take advantage of this beautiful creation that investing is, so that you can grow your wealth over time. And yes, you can have different pursuits, different careers, and so on. But having that capital there, even if you never use it, I think allows you to have certain options and freedom to choose in life, maybe pursue a more entrepreneurial path, start a business, maybe not accept a certain job that doesn't work for you, because you have that pile of savings waiting for you. So when I think of it, I really want to emphasize it when people say, I want to become the richest person in the world. Okay, well, best of luck with that. But there's so much more to it. And there can be many, many more winners in the investment world. I'm just going to say one more thing. Bezos had this interesting remark in one of his interviews. He said, I think he owned at the time 17% of Amazon. And he said, well, think about the other 83%, all of those people that got rich with me. And I thought it was such a big revelation. And it kind of circles back to what we started with: stocks are small pieces of businesses. Yes, the founder will be on the cover of Forbes with his or hers, 17%. But look at all the other shareholders that constitute the other 83%, that took their 10,000 and turned it into 100,000. And they took their 1 million and turned it into 10 million. They all rose with the success of the original business, right? Like, it's a very powerful idea that it wasn't Bezos just for himself and to himself, but all the other participants that also got very, very comfortable and wealthy in their own scale, in their own world with him, and many, many other companies, including Berkshire Hathaway itself. There are a lot of very happy shareholders at that annual meeting.
Yeah, I feel that's true, and yeah, it's amazing, and you really don't see the private investors that got rich from those companies. For example, I follow closely. I'm studying a lot Evolution AB. It's a Swedish company, and a lot of people in Sweden, which is, by the way, not a very big country, got rich because of Evolution, and uh, they really like they are really grateful for that to that business and the managers and so on, because they really impact made a huge impact in their lives, and it's nice to hear those stories. And as I already mentioned, I'm a big lover of stories, and I like to hear those too. But following to the next question, it's not that related, and it's not that technical. But I'm really curious to know what's your system to manage expectations in investing and in life, especially knowing that you're investing for the long run, and obviously the feedback loop gets extended by a lot when you are like investing for the long run. And I bet you're not constantly checking if your performance is better than the S&P or worse and so on. So how do you keep yourself in check and keep the expectations low for yourself, and or yeah, how do you manage expectations?
I think over time my expectations became more qualitative rather than quantitative. and and I asked
Okay.
myself, am I enjoying the ride? Am I enjoying the journey? So when it comes to life and investing, I think I'm an cautious optimist. I want to be aware of potential trouble, but at the end of the day, I love seeing my businesses do well and go up, and I think that that brings me a lot of joy. But it's not just that; it's the intellectual pursuit of making sense of those businesses, and a bigger, I think, calling where I see that the money that I'm responsible for has a meaning and importance in my client's life. It's a
Right.
life changing experience for them, and I get to be a part of this journey, which I find as a huge blessing. I feel very fortunate. So I think to me, I'm driven by curiosity. I want to get out of bed. I want to discover new things. I fall asleep sometimes reading something fascinating, and I wake up writing about something that I'm very intrigued about. So to me, in terms of expectations, it's just this never ending, ongoing curiosity and pursuit of something new. And investing, I see it just as a little lab in a bigger lab of the world at large, where you can deploy your ideas and test them in a way. It's say, you and I disagree about a certain stock. That stock doesn't care what we think about it. You and I can, respect each other. And a lot of investors, you'll realize, might have the same principles and end up with the very different conclusions about the same stocks. And it's absolutely fine. That's what makes the market interesting.
Yeah.
And I don't have to have anybody agree with me. I go in and I'll buy 100 shares, 1,000 shares. It doesn't matter. And then the market will tell me if I was right or wrong. You asked about the feedback loop. I think the tricky part with investing is having, I'm a big proponent of, you can tell, longer term investment horizon. I think picking a stock that will go up in a week, it's not a game that I want to participate in. There's this very fascinating study that shows if you took the daily price movement of the stock market, it's about a 50-50 split if you look at the daily price. If you ask me if it's going to be up or down today, statistically, it's a 50-50, a coin toss. But if it's a 1 year, 5 years, 20 years, you're going to see how over longer periods of time, the odds of the market being up are much higher. And I think that's where the magic happens. If you have a very long term investment horizon, the odds of you succeeding in the sense of you'll end up with more than you started with are higher. And the actual return, it's very tricky because people publish those and they obsess about it. At the end of the day, the goal is that the money that you save or the money that you inherited or the money that you earned, that the market, the investment opportunity allows you to grow it over time. It's kind of secondary if you're compounding it at 7% or 17%. I mean, obviously, the higher the better, but it's the journey that matters, right? So there's some remarkable track records out there published that were accomplished with a lot of volatility, very concentrated portfolios, big drawdowns. not a lot of people could stomach that. So you kind of have to balance between what kind of return is worth your time, and second, what kind of an experience or journey you are willing to, tolerate. The numbers don't tell the whole story, right? When people say this manager had, 20% return and the market was 10%. Well, show me how you got there. I think this will tell you,
Yeah,
a bigger picture. But I think Munger had this saying, lower your expectations, you're going to be a happier person. I'm paraphrasing here, but I think there's some truth to it. If you have very, very high expectations, you will possibly, at least in the investment world, try to tolerate much, much higher risks that can get you in real trouble. And you can get away with it for a long time. That's the confusing part until you don't, right? So it's
yeah,
the longer you stay in the game. I had Luca Delana on the show on Talking Billions who talks about game overs. In some pursuits in life, you don't want to have a scenario that's a total game over. He tells the story of a skier that competes and has 10 competitions in a season. If he or she breaks the leg in the second race, they're out of the race completely, right? So it's a game over. So it's not the fastest skier that makes it that wins. It's the fastest skier that gets to participate in all the races. I think it's a very powerful idea when it comes to investing. You want to be the one that will be there year after year after year over decades. Never have a total wipeout.
yeah. That's true, and I hope to stay disciplined, and I'll do my best in that, because like when you have the luck of maybe having a, I don't know, 80-year-old horizon to invest or something, you really don't want to again have zeros that can really mess up the whole journey. So that's an interesting concept for sure. I'm I really want to use that Charlie Munger principle of inversion, you know.
Yeah.
So what would 17-year-old Bogumil ask present day version of Bogumil?
Is everything going to be okay? I actually
Yeah,
wrote an article that your listeners can look up on my Substack. They can just Google my name and look it up. And I wrote a letter to a younger self. And I actually like the idea of a future self and a younger self as a mental framework, a concept.
yeah,
And I wrote about it how, if I had a chance to say something to my younger self the other way around, I would have told the younger self that everything will be okay. But at the same time, I write in my piece that if I said that everything will be okay, would I have gone? Would that affect the journey? Because I would have not tried as hard. Maybe I wouldn't show up again. Maybe my persistence wouldn't be the same because the older self, it's gonna said it's gonna be okay. But maybe it is okay because I took that one more call. I wrote that one more email. I sent that one more application. So I think it's that healthy balance between knowing that somehow things will work out, but in the moment, make a genuine full effort that you can make. And there are those, critical moments when you're applying for a certain school or for a certain job. Find a way so that you feel that you gave it what it really deserves, a full shot. And I think that really helps in life, being able to take advantage of those different opportunities that arise. But yeah, at the end of the day, everything will work out.
that's that's a powerful sentence there, and yeah, I agree. I guess that uncertainty and like not knowing that it will work out actually makes your biological survival like mentality like be activated, and you really want to go the extra mile. And yeah, I think it's useful. And if you at the end of the day, if you knew that everything would work out, maybe again you wouldn't work as hard and so on. So I think that's a powerful concept for sure. And yeah, just to wrap it up, and then we'll do a fire round, which is an interesting concept that I really like to ask to my guests. But before that, I would like to ask you, like, what's your ideal? What does your ideal day look like? Like, what's your perfect day? Let's say.
A perfect every day, or like the best day that I can think of?
No, not really. Just like a random day, like you wake up and like it's a normal day, nothing special, but you can like at the end of the day you can say, okay, this was like a pretty damn good day. I like it. I would love to repeat this day like over and over. So what does that look like for you?
It's I try to have as many of those as I can, but it's a nicely balanced day where I have a good night's sleep. I can go for a nice walk or have some physical activity in the morning, have a nice slow breakfast, get some reading done, feel productive throughout the day. I'd like a lot of rest and breaks in between. I feel like my mind is sharper. I pay more attention to it. I had quite a few guests on the show, Carl Honore and Alex Pang, that talk about rest and going slow in terms of how we treat our bodies. I had Lucas Miller also on the show who talks about how we have to be kind to our brains because he calls us knowledge workers as athletes from the neck up. That our brain is our powerful resource that we have, and it gets tired throughout the day. So it's a nice balanced day with productive elements, good rest in between, some activity, and I like being outside. So as much as I can, I head out outside, and I actually hear from a lot of my listeners that they take my podcast on the go. They go for walks and hikes, and they listen to the podcast. I'm sure they do the same with yours. But I feel like the time outside in nature, among the trees, or on the beach, or on the hike, lake, whatever it is that's close to you, I think that really matters. And having those quite a few productive hours throughout the day where I feel like I got somewhere, I found something, I had a powerful conversation or something that really made a difference. And I journal every day. I find it very helpful to write down what is it that happened today that I will remember 5 years from now. It's a powerful thought. Like, what is it that you did today that you think will still matter to you 5 years from now? And some of the little things that you're obsessing about, I don't know, petty things will fade away. And some bigger ideas are the ones that will last. Kind of the same as the investment formula, finding things that stick, finding things that are worth the wait. That's a nice balance day for me.
Love it. I really love it, and I can resonate with some of the things that you said. I also enjoy to be outside and practice sports and so on. So, and I also take a nap every single day. So I really like to rest too, and I feel like my brain works better when I take breaks and so on. Yeah. So basically, to wrap it up, we'll go into the fire round, and you are only allowed to answer with a short phrase or a couple of words, and I'll tell you like three things or ideas and so on, and you have to comment like be quick. You know, the first thing that pops into your mind,
All right,
just
let's do
to
it.
wrap it up. Okay. So the first word is. I'll wait for you to end up
Yeah,
drinking. Okay.
I'm
The
ready.
first word is relationships.
The most important thing in life, I think, it's people. We talked about it, how the clients that I have, the friends that I have, the network of people that I was able to build, and my spouse and the family. I think that's very important. So relationship is key.
Cool. The future.
I'm very optimistic. I'm very excited. I don't know why, but I feel like there's so many new things happening, and I've experienced so much wonderful change in the 4 decades of my life, and I'm very excited about what's ahead. Very optimistic.
The past.
I think lessons and wisdom. If you can look at the past in a way as I call it a treasure trove, just finding answers for why is it that you do what you do today. I think the past has a lot of answers. My own past, and I think history at large, I think has a lot of answers for us.
Cool. That were awesome answers, and I was really curious to know what would you say to these three words, because you deal with your day to day is a lot about relationships. You have to really understand your clients, especially when managing like long-term wealth and so on, and maintaining that wealth. And the future and the past also seem something that you spend some time on, and I was really curious to know what would you say. So that those were amazing answers, and really I have to thank you a lot for coming on the show, on the podcast. I was really curious to know you better, and I really enjoyed this moment. And so, thank you so much. I'm very grateful for it.
No, I really appreciate it. Some terrific questions, very thoughtful. And it's always fun to see somebody that's so enthusiastic about investing and see how it's shaping your life. You and I talked briefly about it before we started recording, but how you're thinking about how investing will have an impact in your life, what kind of studies you will pursue, how you will continue to learn. And I think it's pretty remarkable that you got to discover Warren Buffett and the whole school of thought behind him so early on. And I think it will have a remarkable impact on your life, quality of thinking, and everything else that you choose to pursue. And I really like that you decided to start a podcast because you and I spoke about it. I think podcasting is such a fascinating pursuit where you have those incredible conversations with fascinating people. And I have people that I respect a lot, and they come to the podcast and they talk to me, and I feel like I get to know them, the real them, that maybe the pages of the book wouldn't fully cover, but a conversation and their voice and the way how they talk about certain aspects of how they think allows me to see the fuller person. And you and I spoke about it briefly, but I think podcasting is it's a fascinating medium, and I think it's still early on, and I'm very curious how it will continue to develop and grow. But I have a lot of fun being on the other side of it and asking questions. But I like to sit down and hear what kind of questions you have in mind. And I told you that there's something powerful behind the questions because it's the way you ask the question tells a lot about what's on your mind because you're looking for
Yeah.
a certain answer. So it's really fun to see what kind of questions came to your mind. So thank you for today.
Oh, thank you so much. And I couldn't agree more. Like, this has been the best thing ever. And I'm really grateful again for all the guests that have come on the show and agreed to talk with a 17-year-old that has little to offer. But yeah, big curiosity. And I found out that we are both Jeff Bezos fans. So just like Jeff Bezos says, you don't choose your passions choose you. And so I guess that investing kind of chose me, and so I'm very grateful for that. And thank you so much again for coming. And I think that's a wrap.
Thank you so much.